Welcome everyone. We're ready to get started on our webinar. I'm Sarah Wheeler, Managing Editor of Content Solutions at HousingWire, and our topic today is the top 5 profitability strategies for lenders in 2020, which is sponsored by Mortgage Capital Trading. A few housekeeping items first. We will be having a Q&A session at the end of the webinar, and you can submit questions at any time by clicking on the Q&A icon on your screen. Also, HousingWire will be sending the webinar recording and deck to all registrants in the next 24 hours. We're ready to dive in, so let me introduce our moderator, Chris Anderson, who is the Chief Administration Officer at MCT. And Chris, take it away.
Well, thank you so much, and thank you everybody for joining us. We're really excited to have this opportunity to speak with you today, and appreciate everybody taking your time out of your day to share this with us. So, just a brief introduction of myself. As they mentioned, I'm MCT's CAO. I've been with the company for a little over 7.5 years. Prior to that, I was in local government. So I've got a wide variety of background in managing different divisions. Particularly with MCT, I oversee a lot of our technology divisions. We have the country's largest outsourced lock desk, which is one of my functional groups. Obviously, all of our administrative services, and then I work closely with all of our new hedging onboarding accounts as well. And I want to introduce my co-presenter here, James Deitch, who has obviously got a much better picture than I do. And as you can see, the man has written every book in the world, and I've written none. So don't hold it against me. Jim, why don't you share a little bit more about yourself, sir?
Well, Chris, you're way too modest, but thanks for the introduction. And pleasure to be here with Chris and the MCT team and the rest of the participants. My background is about 30 years as a residential mortgage lender, started 3 companies, and got into the professional services business after selling the 3rd company in 2011. And one of the things that MCT has graciously agreed to do is to provide a digital ebook of my best-selling book, Digitally Transforming the Mortgage Banking Industry, to every participant. So you get a link to download that, and it'll come as an ebook to you. Chris, again, thanks for the intro.
Yeah, absolutely. And thank you, Jim, for providing that ebook. It is a great read, actually, as all of these are. And Jim and I have had the opportunity to work together on, dozens of mutual accounts, and really excited to be able to present with you guys together here today. So what we're talking about today really stemmed from an effort that we started, late 2018, early 2019, when several of our, at MCT, between my company and Jim's company, we've got hundreds and hundreds of lenders that we work with. That could be, credit unions, depositories, independent mortgage banks, correspondent lenders, you name it, kind of runs the whole gamut. But obviously, it was really top of mind to everybody, in the last quarter of 2018, first quarter of 2019. Profitability was really on everybody's mind, and squeezing every dime that you possibly could out of every loan became more and more important. Now, what I've seen over my years, and certainly when we are looking at performance now in 2020, the picture may appear to be dramatically better. But what we think at MCT, and obviously at Terra Verde, at Jim's company as well, we think that this is something that folks need to be focused on all the time, all throughout the year, every quarter, and it needs to be down to looking at your profitability per loan, your profitability per loan officer. And we're going to be going into a lot of these areas, obviously, in more depth with these top 5 strategies to increase profitability. The first, of course, is we're going to be talking about, if you aren't hedging and delivering on a mandatory loan sale basis, we're going to give you some information about that. We're going to review technology really plays a key part in this overall formula for increased profitability. So we're going to be talking a little bit about secondary marketing technology. Jim's going to be giving us some great information around managing operations and sales performance, tracking and improving your customer satisfaction, and then really focusing on measuring profitability, as we were talking about earlier, over each business unit and even over really down to that loan level basis. So we'll go ahead and dive into it. And again, I know we have several hundred folks on the call, so many of you may already be hedging and delivering on a mandatory basis. But if you aren't, it's really something that you want to consider. And, generally speaking, I'm pretty comfortable saying, hey, you ought to be able to see a 25 basis point pickup. There's, certainly the ability to do more than that. And if you're following a good hedge program that is conservatively managing your risk of interest rate change, and then you're executing on a short-term mandatory basis, and you're utilizing all of the different best execution options that are available to you, you really have the ability to maximize that profitability. And to just spend a little bit more time talking about hedging and delivering on a mandatory loan basis, just for some of the folks that may not already have done that. MCT has worked with literally hundreds of clients that are delivering on a best efforts only basis. And so you really need to feel comfortable with taking that step. And so obviously, if you're going to begin hedging and you're not an organization that just wants a software system, we have software that we certainly sell at MCT. We have folks that are, initially transforming from best efforts to mandatory. We have folks that are, mandatory, that are already hedging and delivering mandatory and may just, be using our service. We also have folks that just use our software service. But the idea is that all of these lenders, whether they're a correspondent, a credit union, a depository, an independent mortgage bank, all of them are looking to take a hold of this increased profitability through hedging and delivering on a short-term mandatory basis. And when you're evaluating a partner to assist you doing that in any of those, lender types that I just discussed, I'm not the best sales guy in the world here. I should probably say you should only be talking to MCT, but I think it's very important that you evaluate. There's a competitive landscape out there. There are a few other companies that provide the same services that we do, and I would always encourage folks to speak to a few different providers to make sure that you really resonate with your provider. Where MCT has been very successful is the ability to take some of the fear or some of the concern around the risks that could be associated with hedging and delivering on a mandatory loan sale basis. And the way we do that is just by having a really transparent model and a really educational forward onboarding process. For example, either myself or our chief operating officer are still personally involved with every single new account that we onboard. And I'm such a data nerd that I literally am involved with, hey, what fields are being transferred from your company to MCT? And the reason why we do all of that, and at our executive team with, I think we have 220 some odd hedge accounts that we still allocate that much of our time from an executive team, is that we really want our clients to understand not only the benefits of the mandatory loan sales, but also we want you to understand what you're doing. And oftentimes the client will start with us that maybe is a best efforts to mandatory seller. We're managing the whole account. We've got 25 to 30 traders between our California and Texas and Philadelphia offices that are available to work with folks and that manage accounts. But a lot of our clients over time will begin to graduate to taking more and more responsibility on, which obviously, makes the fees that they're paying us a little bit less, of course, but that's where we really kind of want to partner with you to help educate your team and grow you into a lender that's able to benefit from this. And, a lot of emphasis is placed on best execution and the amount of basis points, right? Hey, if I'm a business owner or a president of a mortgage division or I'm running capital markets, I want to know what my ROI is going to be. So while I can throw out, 25 basis points to you as a target to make, again, it can be a lot more than that. But what I think sometimes gets overlooked is you have so much more flexibility when you're hedging and delivering on a short-term mandatory than being tied to best efforts, for example. If you take a 45-day lock down and you are able to close that loan in 39 days, well, your best efforts investor is not going to give you that difference for that 45-day lock period. But that's an efficiency right there that you get that time value of money recognized yourself that you don't invest efforts execution. There's also several different operational efficiencies that are gained that allow you to, for example, to have some benefit from adopting your own extension policies and relock policies and renegotiation policies. So you're in control of that yourself rather than pushing that off to dependent on whatever best effort investor you may have. So really what you want to look at, as the slide here indicates, there's three sort of main components when you're looking at hedging and delivering on a short-term mandatory basis. That's managing risk, maximizing profit, and then that improve operations. As a operations guy, I love that. So if you're interested in that, if you're not delivering on a best efforts to mandatory basis, or pardon me, on a best efforts basis and not a mandatory basis, definitely encourage you to take a look at that. And evaluate, a couple different companies. And of course, I'll tell you that we're the best, but you need to make that decision for yourself. So as we look at a second strategy associated with sort of that initial one, is if you're already hedging, which a lot of folks on the call may in fact be, you're already hedging, you're already delivering on a short-term mandatory basis. Are you taking advantage of all of the different best execution opportunities that you have? Jim, you and I were talking, earlier today about a couple of our mutual clients that we've seen where they may be delivering on a released basis, but they're delivering everything over to Fannie and Freddie, for example. Do you want to share some of your comments on that?
Chris, that's an excellent point. Some of our clients, particularly the depository side, tend to view the Freddie Fannie execution as very easy and very fast. But when you look at the best efforts element of that, and one looks at what the particular correspondent bidders may be able to pay for that particular loan set, we did an analysis with one particular client that I'll tell you a little more about in a bit. But they were able to pick up 12, 13 basis points simply by optimizing their investor group. And that in and of itself, for this particular lender that was doing northwards of $1.5 billion, that's real money, and that hit the bottom line. Yeah. But more on that in a bit.
Yeah, absolutely. And that's something, again, we get to, both Jim and I are working with so many different clients out in the industry that we get to kind of see a little bit of everything. And I've definitely seen that. And I have seen it in a theme a little bit more, like you were saying, around depositories and credit unions to some case as well. So if you are delivering on a mandatory basis, you're already hedging. If you're working with, a hedge provider, definitely get their insight over to all of the different execution options available to them. We recently have started working with, we went live in about 2019, maybe the latter part of 2018, but this slide really does a great job. The bid tape AOT, really wasn't being actively used in the industry if you went back into 2018. It was a more manual process that required, documents to be signed and passed around, and MCT was able to automate that process electronically. And you can see this slide, sort of speaks for itself. With bid tape AOT, folks are able to pick up, another 6 to 8 basis points, right? And in our client base, with you can see in that second bullet point, that actually ended up being about an $80,000 additional profit per client, and that's real money, So you definitely, if you aren't taking advantage of the bid tape AOT, talk to your provider. There's some requirements, of course, but that's just one of the additional execution options that are available to folks. Jim just made a great point too about optimizing your investor set. So listen, I've gone through getting approved with different investors, and what a pain it is to go through all of that paperwork, but that's really worth your while to look at your investor set, and not only just look at, do you have the right players, but are you getting the right pricing? Are you getting the right information from from your current vendors. So we always encourage that you evaluate that. And then if you're working with a hedge client, you want to be sure that, or a hedging firm, be sure that they're providing you that information as well on best execution analysis. So I'm going to move in to talk a little bit about technology. Everybody talks about technology's role. Excuse me. I'm getting so excited. I'm getting choked up over here. I love this stuff. So everybody talks about technology's role in making our companies more efficient, more profitable. It's not just, secondary marketing technology. I'm sure all of you are dealing with vendors, anywhere from your, if you're using a payroll, an HR system, or if you're using a document imaging system, or, anywhere in between. Technology really does have the ability to increase profitability. Now, specific to secondary marketing technology, some of the things that we've done at MCT that have really been, have really had a dramatic impact on our clients' bottom lines are the automation of, if you can imagine it, even a year ago, 18 months ago, in order to get a bid tape processed, people were, filling out spreadsheets, sending them to the investor, forget the fact that there may have been some NPI that wasn't being protected in the best way possible. It's a manual process where, you have high value secondary folks cutting and pasting, data into Excel and then firing that via email over to the different correspondent lenders that were going to be purchasing their loans or bidding on their loans. And then those lenders may take an hour or 30 minutes or 2 hours to come back. And so if you're sitting in a lender running their capital markets and handling their loan sale, you have to then manually sort of market adjust for these bids coming back and forth. And what we were able to do through what we call BAM, our bid automation system, is automate all of that process. And so, and make it dramatically more secure so that all of that, all of the management of that bid process is taking place within our secure environment versus shooting out transactional information all over the place via unsecure email or less secure email. And then the really nice thing is that as more and more lenders are automating their side of the pricing, we're able to get those results displayed back to the end user much, much more quickly. Now, for a lot of our clients, we manage this process for them as well. But for clients that were managing this themselves, we've got several case studies. And Jim, I'm sure you could speak to some of your clients that have realized real savings just in time by automating this process, right?
No, absolutely. The ability to automate the entire process and really harvest those basis points is just a very important part of secondary. When one looks, and we'll look at the profitability numbers in just a minute or two, when you look at the average profitability over the last 2.5 years of being below 30 basis points, each of those basis points represents 3 to 4% increase in total profitability over those 2.5 years. So it's not theoretical. These are hard dollars and cents that Chris is speaking about.
Yeah, and the other thing that we sort of picked up on, and again, MCT has this outsourced lock desk division where our competitors don't have that business segment. But what's been really interesting about that is seeing how just sending a completed report with all of your best X information, let's say, we would send it to a client. Well, if we didn't have the lock desk, we would never realize that, geez, what does that mean for the client? Well, it means that if you sold 25 loans or 180 loans that day, now you have someone on your lock desk, and then oftentimes it could be in a smaller shop, a very high value employee that is now spending hours just keying information into their LOS. So one of the things that we really push on all of our clients is this ability to facilitate automatic LOS data write back. And based on our client base, you can see that it saves 8 hours per week in aggregate when you look at hundreds of our clients. I've personally sat and had to key in, 180 loans in an evening, and that might save you 8 hours just in that one day. So the other thing that's really interesting about the data write-backs that we provide or system automation that your current LOS provider might actually already have. I often run into issues with clients where they just may not be fully aware of everything that their current LOS or their current pricing engine or maybe a POS or a CRM. You're paying really good money for this technology, but you may not be aware of all it has to offer. So for example, a lot of LOSs have bulk upload functionality. We've built some stuff that's a little, that works better, frankly, in my opinion, but you want to be maximizing all of these different offerings that are available to you. So while it's a pain to, keep up on the training material and the release notes, I really encourage folks to actively participate or at least designate someone on your team that's going to actively participate in all of those types of training. So when there's user conferences, you want to evaluate them. Is it necessarily, worth spending thousands of dollars to send someone to a user conference, or would that money be better spent on allocating time in that person's, work week to just keep up on release notes and utilize a lot of the videos and training documentations that are available within these platforms. And then the other thing too is when you're speaking with vendors, talk to them a little bit about their technology roadmap. What other systems do they integrate with? Because as we can see, these integrations really are exceptional ways to maximize profitability in reduced workload. That outsourced lock test, for example, that I was talking about, I found that oftentimes LOS and pricing engine providers aren't able to really take the time to talk a lot about secondary because it is a smaller portion of the overall loan manufacturing process. But we've implemented, kind of the best practices around rate lock workflows, and we've actually easily achieved, a third of an FTE, a half of an FTE, a full FTE, depending on how large a client is, just by really optimizing that technology and making sure that, you're using your pricing engine the best way you can, and that it's talking to your LOS in the best way that it can. So that's always important to do. The other thing when you're looking at, say, a new investor is how is their automation handled? Do they have API integrations built out with your hedge provider, for example? Are you able to pass document stacks really efficiently through your LOS? And evaluation of the technology, I think, is really important and sometimes gets overlooked. You're wanting to try to get the best price you always can on loans, but you also want to balance that with the most efficient delivery. And we're seeing, and we're really excited about it. For example, at MCT, we've created and ways to commit directly from our system. We call it Fannie and Freddie Rapid Commit. So where our staff, or if you're a lender that's using our software, rather than having to log out and go onto Fannie or Freddie's website, you can just commit directly out and secure your pricing, and that's been really exciting. Along with a lot of the API integrations for pricing, we've done a really great job of working with investors that are tech forward and trying to gain everything we can out of that, because in making your delivery to the agencies or to correspondents and your pricing more efficient, anything that's really making you folks more efficient is typically coming right back to us and making us more efficient as well. So you really want to pay attention to this, I think, across your whole, your whole loan manufacturing process. But we've seen the ability in secondary marketing in particular to really add some efficiency, which protects your profitability and increases it, especially as volumes, like we've seen, a lot of folks over over the last year, if you looked at January volume versus July volume, boy, there's a lot of work there. And if you have to staff up for those volumes, you're in a slower pace to keep efficient with that. So I think everybody recognizes this. And again, I would just say that we're able to really quantify the ROI. And there's some great business intelligence tools too. And some are native to your current application. Some are, Jim's going to be showing us some examples of a BI tool that he has that we work with several customers on. And there's a lot of different platforms out there. But I think the one thing that's really important is that you're investing so much money in technology, you have to invest the time to sort of support that technology, keep abreast of everything that's going on with that technology, maximize its use, and then really commit to taking action on the data that, especially in the BI world, on the data that you're receiving. So you guys must be getting tired of listening to me talk so darn much. But Jim, I just want to ask before we migrate over, would you agree that particularly in the BI world or business intelligence world, I've seen folks have all this great data, but they aren't committing to acting on it. Have you run into that issue at all with some of your clients?
There's two answers to that, Chris. The first is there's a tremendous amount of data out there. And on the slide you're looking at, that automatic write back, when we look at data before you do anything with any visualization or any analysis, is you go in and evaluate the cleanliness and the integrity of the data. And our industry is on a scale of 1 to 10, with 1 being horrible and 10 being fantastic. The best players are at a 6, and the average player is at a 4. So we've got a lot of room to go. So don't look at that write back or that automatic passing of data back and forth as simply a labor save. The number of errors that are made, and when you look at what's been keyed versus what's been transmitted by API, there's a big difference there. And the second element is, to Chris's point, that we are really in a world where disaggregated data and getting the intelligence from that data is really important. One of the privileges I had of writing 3 books on the mortgage banking process is I've talked to about 300 CEOs, both in and outside the industry. One of the most interesting CEOs that I spoke with was Billy Beane of the Oakland Athletics. And Beane's commitment to data is legendary as illustrated in the movie. But as he and I spoke about what you can do with data and how it can really differentiate between, on average, what a batting average is versus how you can get the most out of a player in a particular situation, that's where the analysis of this data really comes in. And I think that's really true in looking at a technology like BAM. It just allows you to really examine that single loan through so many different dimensions and so many different lenses that the ability to maximize the profit at the loan level is where our industry is heading. And to do that, you need automatic data transfer and you need good data integrity.
Yeah, that's a really good point. And I will have to admit, when I was keying in those 180 loans myself, I was built in a little auditing program for myself. And, I did make quite a few mistakes, Jim. So there you have it. And it is great now that we're able to minimize that. And you're absolutely right that removing the kind of fat finger errors really does make a difference. So let's go ahead, Jim, and let's have you start talking here a little bit about, I'm jumping into our third strategy, sir.
Excellent. So again, Chris, thanks for the invitation to speak. And one of the things that I've gotten from interviewing those 300 CEOs and C-level people is a lot of them are very blunt. So I'm going to share some of that bluntness with you today with respect to some of the data we're looking at. And in particular, this is information shared from Mike Frattitoni at the MBA, and it looks at the basis points of profitability and what a difference 4 quarters makes. Last year, 2018, fourth quarter, the beginning of 2019, the misery index in the mortgage banking industry was really high. And all of a sudden, we've had 2 great quarters, probably going to string the fourth quarter to look somewhere in that 70 basis point range. And all things are wonderful. But if you look at that trend line, that little dotted trend line there, and look at the volatility of earnings, the ability to consistently get above 50, 60, 70 basis points is where many of the people in this business think the right return on equity happens to be, not where we've been. So while it may seem really great like now, the opportunity to do a lot better is sitting in front of us. And I'll give you an example. One of the lenders we jointly work with used some of this disaggregated data to look at the best way to increase the ability of loan officers to contribute to the bottom line. And that's a little bit of an issue because you can't differentiate on loan type or loan characteristic. But by selectively going through and looking to find the products where you could squeeze that extra 10, 12, 15 basis points or more out of by execution, and then working with the marketing team to get those products to be favored, this particular lender, in the course of 6 months, added $3.5 million of pre-tax to their bottom line. Now, I don't know of all the people in the audience if $3.5 million is material or not, but in my book, it's pretty material. So the basis of our discussion today is really this volatility and the trend line that said, absent the last 2 or 3 great quarters, we really haven't had a good record since the end of 15. Next slide. And that's driven largely by cost. And the red line that you see there is just the arithmetic average of the last 12 quarters. And again, the trend is slightly up. Now, one can say, yeah, our costs are coming down, but that's because we've had two really good quarters. One of the things that I really get impressed with is that the CEOs that I interviewed for the books and many of the people that I work with aren't looking at how do we save $20, $50, $100, $1,000. The question they're asking is, Jim, what can we do to literally get our loan costs down to $3,000 or less and do it in the next 4 quarters? That's a pretty big ask. And if you get nothing else out of our time together today, write that down on your notepad. To really make a transformational change in this business, you've got to cut the costs not by 5% or 10%, but by 50. And there may be people on this call that say, Jim, that's not possible, and perhaps it's not. But there's a lot of people out there in our business and some contemplating entering our business that think they can get to that $3,000 number. And if we're not paying attention to the possibilities of how we do that, we're likely going to be surprised and not in a good way.
Yeah,
so when you look at that trend, go ahead, Chris.
I was just going to say that's a great point, Jim. And I was going to just ask you your opinion. I know I've seen, say, for example, the amount of time I spent just dealing with vendor due diligence and compliance from, 7.5 years ago, maybe being 5% of my job to now being 50% of my job. Are there some key areas where you feel like the costs, the expenses are really centered in?
Yeah, so I mean, sales cost continues to be a very large segment of that.
Right.
$7,200, $7,300, and when you're doing self-sourced business or direct retail, it's a little more difficult to necessarily control that. But I'm going to show you some examples of how one of our lenders has really gone through and analyzed it and how they have found who is really contributing to the bottom line and who isn't. The second piece is that directly sourced data and directly exchanged data is going to make, I think, a huge difference. According to the MBA and in talking with Mike Frattoni, the chief economist, the operational element of our business, that's processing, underwriting, closing, post-closing, all the touch labor that occurs during the loan process has between 50 and 70 hours of labor embedded within it. And that's a huge number when you think about it. It's hard to imagine how you can spend that much time, but I'll show you a graphic in just a minute that goes through where some of that labor happens to be wasted. So it's really on 2 parts. One is really getting the most out of your particular origination channel, and the second is thinking differently about how to lever labor. And if you can take a lot of the data entry elements out and take the mistakes out, so you do one process once and move on, That's the key to moving down towards that 3,000. And some of our clients go, well, Jim, I can't get to 3,000. I only got to 4. Well, that's a huge win, right? That's a huge win. So, Chris, if you can skip the next one.
Absolutely, sir.
Yeah, so this goes down to productivity. So the dark lines are closings per loan officer, sales employee, and the gold line is the closings per fulfillment employee, which includes processor, underwriter, closer, but not the back shop people. And again, the red line that's going down, even though we've had 2 good quarters, the trend of originator productivity is on a downward slope towards an average of about 4 loans. So don't necessarily just look at the last 2 quarters. Think about what all of those performance results, including 18 quarter 1, 18 quarter 2, 17 quarter 1, where that productivity is. Flip to the next. So here's an imperative that if you could go through, and if you look at this graphic, it starts on the left, which has employees which in the bottom 10% of the employees in your group. And the bubble is the next 20% or 30%, call it. The middle is kind of the acceptable or average group, and on the right is the top performers. One of the things that in talking with Bill Emerson at Quicken, as well as Billy Bean at the Oakland A's, they both said exactly the same thing. Culture drives everything, but if you can build a culture of top performers, and that breeds more top performers. The other thing that I'll show you in just a minute is the top 10% of many of my clients' originators contribute more than 40 to 50% of their pre-tax profit. And I'll say it again, the top 10% of the originators, and that includes retail, direct-to-consumer, TPO reps, contribute 40% or more of the bottom line. Hard to imagine, but I'll show you the math in just a minute.
Yeah, that is an amazing.
Next slide.
Yes, sir.
Yeah. So the next thing is just going through and looking at profit leakage. So if you could magically move all the loans to the upper right quadrant, which is high number of loans and high profit dollars, you'd have a bigger part of that donut being in profit. So where's it lost? Some of it's lost to rework when you're doing the same issue over and over. That's underwriting turn times or underwriting retouches, et cetera. Some of it's poor follow-through, where you just don't get the borrower to give you what you need. Some of it's driven by cures and concessions and duplicate work and missed LPAs or LLPAs. So all of these issues are just eating away at that top line, and literally every dollar lost in profit leakage and revenue leakage is a dollar that's lost to profit. So I use these graphics really just to drive home the point that there's a huge opportunity to increase the profitability of one's business. And if you look at the opportunity of what profit is available to be taken, if you were 100% efficient, that 1/3 could actually move all the way over to that full donut being green, which would be a meaningful increase in profitability. So let's look at a couple of specifics. Chris, if you flip to the next slide.
Yeah, Jim, I just wanted to add one thing is I just happened to sit on a call recently about this with a technology provider. That price concession, while it's a smaller segment of your donut there, if you aren't using your LOS and your pricing engines, price concession request and approval tools, it's something you might want to take a look at, just as an aside here, Jim, and I'll move on.
No, Chris, and that's an excellent point because, in some shops, people talk about a very high pull-through. The question I ask is, what's the pull-through without concession? And if I get a quizzical look, I know it's big.
I 100% agree with you, sir. I've had those conversations.
So I'm going to take you through this fairly quickly to stay on time. But it's a look at what that LO or that producer, and this could be TPO, it could be direct-to-consumer, it could be a loan officer. The math is the same. The numbers may be a little bit different. But here's the tale of 3 loan officers. I often ask CEOs and folks about, tell me about your business. And the first words out of their mouth is, we do 500 million, we do 2 billion, we do 3 billion, we do 5 billion. And I ask, who are your best people? And invariably they'll come back and say, well, Joe has done, $26 billion or $22 million, whatever. And the next question I ask is, and who's the most profitable loan officers? And some people can tell me, many can't. So let's just walk through how you find what that contribution to profit is. So that $20 million really depends on mix. So in this case, I've got a high govy producer, a high conventional producer, and a high jumbo producer. So we already know the profitability is not going to be the same. But if I layer in the margins on each of those loan officers' products, which is the next slide, one can take a look at what the margin or the contribution margin. When I say contribution margin, it's paying the producer for exactly what they can do. Get the product sold, get it without a concession in the price, get it at the price and the fees in which the lender specifies, and that's their contribution margin to this product. And some of these margins may not square up exactly with your business, but these are illustrative. So we see right off the bat, mix makes a big difference. And since Dodd-Frank made it difficult to price or to pay loan officers on loan terms, we're stuck with one commission rate for that particular loan officer. Next line. And in this case, I've taken some data from an anonymized data set from one of our clients. And when you look at the commissions, you see they're roughly the same. But when you look at the concessions, you can see the concessions are also eating away at profit. So when you look at this, and starting at the top is loan officer A, B, or C the most profitable in terms of contribution, you can see there's a big difference. When we express that in terms of basis points, which is what the MBA and many people do in terms of comparing things through a common denominator of basis points per loan, just flip to the next slide, you'll see that the loan officer, back one, yeah, you'll see the loan officer on the right contributes 108 basis points. So 233 gross contribution margin because of mix, 25 basis points lost to concession, 100 basis points of commission, leaves me with 108. The loan officer on the left starts with 398, no concessions, 100 basis points of commission, and leaves me 298. So this example was extreme because I picked the poles, one of the most profitable loan officers with one of the least profitable loan officers. But I guarantee you, if you take this and use this math and then think about how you're setting commission rates against mix and margin, although you can't pay the loan officer directly on their mix and their margin, you can create your commission plan that are based upon the expectations of what that loan officer is. So again, if you take nothing more out of our time together, you can do this by hand. I'll show you, if you flip to the next slide, we've done this in a mechanized way. And what we've done for this particular client is sorted on the center column there, which you see the bar starting in blue and then moving all the way down. Those are contribution margins by loan officer in terms of absolute dollars. And on the right is the contribution margin of the branches. And one can see that if you stopped at the top 5 loan officers, a very big percentage of the profitability of this lender comes from those top 5 loan officers. And the same is true for the branches. If you look at the top 5 branches, a very large segment of the contribution margin is there. What you can't see in this static slide is if you slid down those sliders and went to the very bottom, you'd see branches and loan officers that have negative contribution. And my question to CEOs and production managers is, why do you have that? And oftentimes it's, well, I never really had the data that showed me how much I was making by loan officer or by branch. So you've got the math on the previous page. It'll be distributed. You can do it manually. You can do it in Excel spreadsheets. We've got a tool that does it. And you can also do it by loan type, whether it's conventional, FHA, VA, rural, and you'll find some really surprising characteristics. Next slide. Customer satisfaction. So this is the J.D. Power Primary Mortgage Origination Satisfaction. Quicken has won again for, I believe, the 9th consecutive time. And one of the things that, if you look at this participation, or look at this ranking over time, the number of competitors, it used to be Quicken up there and then everybody else pretty much to the left. A lot of the larger people that participate in this survey have gotten really close. So Quicken still leads at 880. Fairway, Guild, and Citi, believe it or not too far behind. But here's what's to take away from that. If you find the next slide, one of the key drivers that J.D. Power finds is its satisfaction is largely based upon speed and promises kept. So if you close a loan and you promise to do it in 30 days and you do it in 30 days, you're going to earn 850, 900 in that origination survey from that customer. And think of these as credit scores because it's really a fairly good analogy. If you do it on average, you'll get 800. And if you look in that previous slide and recall, 800 doesn't get you in the top 20. If you don't do it fast, and if you fail to meet the promise to close, and you created problems, you're down in 500, 550 land. And more importantly, that 500, that 550 means that person's going to tell realtors, their friends, all the reasons not to deal with a particular lender. So it's speed and promises kept. So I'm going to show you a very interesting thing from a data set of anonymized data, if you can flip to the next one, in which we looked at two dimensions. So, and I know this is a little bit hard to read, so I'll just describe the most important thing. The lender's overall run of book in terms of contribution margin was 270 basis points. So turnaround there is in terms of days from a high of 35 apt to close to a low of 26 on average across the whole credit spectrum. And this particular lender thought they were doing really well. And we began to go in and say, would you expect your highest credit score customers with the lowest loan to values to go through the system much faster? And because they go through much faster and you can reduce the hedge cost, you should probably make as much, if not more money. And the CEO said, absolutely. So we flipped to the next page and looked at the reality.
Jim, I'm sorry, just before we do that, we had a great question just asking if the speed of closing was for rate and term refis. And I think your system and all of these are configurable by loan purpose as well, probably, right? Or refi.
Yeah,
type.
and
good things.
And this particular lender had about 70% purchase, 30% refi.
Excellent, thanks, sir.
Okay, so here's the surprise. When we looked at credit scores over 750, loan to values under 75, the dispersion, meaning slowest to fastest, got wider. The average stayed about the same. Some of the branches that were taking as high as 42 days on these loans, which were slam dunks, couldn't figure out why the profitability dropped to 111 basis points from 270 on this particular segment. And the reason starts with a C and ends with an S, and the word's concession. Because this was not good operational performance, promises weren't being kept, and these borrowers, which have high credit score, low loan to value, knew they could get financed anywhere. They simply called up the loan officer and said, forget it, I'm going someplace else. The loan officer said, well, what if we lowered the rate? So there's the impact of slow speed and promises not kept. And in the abstract, it's a reduction in the customer SAT score. But in reality, it's a huge hit to profitability. So last slide, and then we'll take some questions, is if you measure that profitability, you have the way to do it by branch, by LO. You can do it by channel, by product, by operation unit, by how a loan comes in, what the point of entry or where the point of entry is, by retention. Lots of different ways to look at it. Not a lot of time here to necessarily talk about it. But with that, Chris, I'll turn it back to you, and we have time for questions.
Yeah, and Jim, thank you so much. And I think everyone has probably realized that you are dramatically better at this than I am, and you have fancier slides than I did. So I'm going to give my marketing guys a hard time about that. But one of the first questions that I see coming through is, so let's see, low-producing loan officers still contribute to overhead coverage, so why don't I just keep them? And I think you sort of spoke to that, but if you want to just revisit that a little bit more, it'd be great, sir.
No, well, Chris, that's a great question, and I often get that to say, look, the loan officer only does two loans a month, but still he's producing 2 loans a month. And my question back is, well, that's all well and good, but that means your overhead and your direct labor and everything else is not variable. Because if you take that same approach and find the most productive underwriters, processors, closers, and look at the least productive underwriters, processors, closers, and the least productive loan officers, if you do the math, that 2 loan per month producer is probably unprofitable. And unprofitable not only in absolute dollars, but think of it, 2 loans a month, those loans have to close. So do you think that loan officer is pestering your underwriter or your processor to do everything possible to make that loan close? It's a lot of hidden costs here. And again, if you take nothing away from this, if you do the math and look at how profitable or unprofitable a producer, a operations person is, you will be shocked. I guarantee the word is shocked at what you could do to your P&L simply by working through either helping them become better or inviting them to be with a competitor.
Yeah, that's a great point. Even just utilizing your LOS, one of the things that I'll do often is just this is not anywhere near as fancy as what you're doing, of course, there, but just a lot of LOSs will give you the opportunity to look at what your original locked price was, and then look at your final, purchase advice price, and then add in loan officer, branch name, and just at that, just start there, and you'll see some pretty interesting trends. We had another question here that said, did we say that the profitability calculator by LO and product mix is available in Excel to share with us? And I think the answer to that is no. That the tool that you have, Jim, obviously that's your BI tool, but I think from your previous example, they could actually do sort of the math in Excel on the tail of those 3 loan officers, right?
Yeah, and if someone wants to just email me, I'll shoot them that Excel spreadsheet if they wish.
Oh, great. Yeah, and we can make sure to distribute that probably as well. So a couple more questions coming in here. One, can you revisit the comment on structuring incentive plans based on profitability? What factors would you adjust to account for product/LO level profitability? And that's a pretty common question. I think we've got another one here that, how can you set commission rates when you can't vary by product but still maximize profitability? Do you want to speak a little bit about that, Jim?
Yeah, Chris, can you move backwards into back to that slide where we had the 3 loan officers in a final spreadsheet right before that? Yeah, so here's what I learned from several of the CEOs I interviewed. When they're looking at loan officers or branches, they ask the question, okay, show me your mix. Show me the conventional FHA. Show me where you're at. Show me your pricing. And you essentially develop this type of approach that says the branch on the right, to me, is not as valuable as the branch on the left, simply because the nature of the product mix is such. So although you can't go to a loan officer and say, I'm going to pay you 50 on jumbo and 120 on FHA and 95 on conventional, you can go to that branch when you're recruiting them and say, look, show me your mix, show me what the pricing is, and you can, from that, deduce your margin, and then decide what you're willing to pay them. And in some cases, you're going to find that that branch just doesn't fit your profitability model because their mix and their volume expectation and their compensation expectation are just in excess of what you can produce in terms of the loan. So the other thing that happens is that you can't do this with loan officers, obviously, but you can sit down with production management and say, look, branch A said they were going to do the type of business under loan officer A, but in fact, they're doing the type of business under loan officer B. So we need to have a discussion about what the compensation and what the overall way of compensation, both for the LOs as well as the branch manager that's being paid on profit, how they're paid. So you can do this in a way in which you're not doing it every month or every week, obviously, but even in recruiting, just to say, what do you expect to do? how are you going to produce business, what's the margin, and what do you expect in terms of compensation for your staff, you get that pro forma and then begin to compare it to actual. And you'll find very quickly the branches that are really, really well producing and very profitable for you versus the ones that aren't.
And Jim, I had another question come in about, I think it's a sort of a benchmarking question about industry averages for comparison. I know at MCT, we have a lot of, in our business intelligence unit, we will do peer benchmarking across our client base. In your BI tool, do you have the ability to benchmark to other, similar tranches?
Yeah, so we benchmark against either publicly available data, which includes the MBA aspects, sure, or a selected peer group among that. So the answer is yes. Great.
We have another question come in that I can take here, or Jim, would definitely like your insight as well. What are the typical volume and business requirements to begin mandatory loan sales? And so, that volume number, I think maybe if you had asked that question, 5 years ago, I probably would have said 15 to 20 million in hedgeable product. And now with all of the different execution options available, I'm actually seeing folks do very successfully with hedging smaller pipelines. But what are your thoughts on that, Jim?
Chris, I think you're exactly right. The ability to exchange data and the best efforts mandatory spread, plus some of the advances with respect to investor optimization and even loan AOT optimization. If you think 10 million, 15 million is a good number, and you can pick up, call it 40 on that, that's 60 grand. That to me is real money, and that is, that is very, very. It's now in the economically viable sphere for both the lender as well as their hedge provider.
Yeah, and I think, to that point too, you mentioned that a lot of times when you sit down with a CEO or a head of mortgage, they'll immediately talk, about their total volume. And I just always think it's great to just, be prepared. If you're going to speak to a hedge advisor, be prepared with some of that, basic, product mix information there. And we're winding down in time here, so I'm going to go ahead and looks like we've got one more question here. And actually, it's a great point. One of the folks attending just mentioned that, hey, before a company looks at going mandatory or hedging and delivering on a short-term mandatory, they need to take a long look at their post-closing delivery process and accuracy and dwell times. And I think that's a great point, and it's something that if you're considering that, speak with MCT, speak with some of the other providers in the industry. And one of the things I always would want to ask is, hey, where am I going to have my problems? What are my risks? And really encourage, if it's my sales team or if it's somebody else's sales team, they should be able to walk you through that and answer those hard questions. Jim, anything to add to that if you're looking at selecting a hedge advisory firm?
No, Chris, I think you covered it.
All right, and I think we're here at our end time, and I just want to thank HousingWire for hosting this event for us. And Jim, thank you so much for joining. We're going to be sending out a lot of this information, and so maybe if I could just ask the HousingWire staff to just talk again about how the information will be distributed, and if we could again just indicate, I think there's going to be a link for folks to download Jim's book, which is really a great takeaway. And Jim, thank you so much for adding that.
Yeah, thank you, Chris. This is Sarah again, and thank you to Jim. These are such great insights. Definitely, if you submitted a question the panel didn't have time to answer, attendees can still get their questions answered offline. In addition, HousingWire will be sending out the webinar recording, and it will also have the link in that email. Our registrants should get that in the next 24 hours. The webinar is also going to be available in our Knowledge Center, which is found at housingwire.com. So there are a number of different ways to access that information, and we just want to say thank you so much to Chris and Jim.
Thank you. Everybody have a great day.
Have a great day.
Thank you.
Thanks.
Thank you, ladies and gentlemen. Bye.